Evolve or Perish. Chapter 6, Corporation Income and the Employees. A corporation produces goods or services and sells its products at a figure in excess of the costs incurred in production, the excess amount representing the profits. The production costs include the cost of labor and material and overhead. The principal cost in production is labor. The cost of material is really a cost of labor, plus profit, imposed on the material by a previous operator. This also is true of fuel, power, rent, and so forth. Every cost is, in the final analysis, a labor cost, except those costs that are imposed to give a return on capital. All that any corporation has to sell, therefore, is service imposed upon a material, or in some cases, just service. If profit is viewed as a compensation to capital, profit must be viewed as a cost item and not something that can be isolated from other cost items. If this point of view is adopted, no product is sold at a profit, but all articles are sold at cost. A fuller discussion of costs is presented in a later chapter. When the executives of a corporation arrange for the sale of its products, provision should be made for securing in the selling price the full return for the value of all services rendered. The sales income from all items handled by or through the corporation belongs to all the participants in the production. The directors and their executives have various responsibilities in the distribution of the gross income, the money received for the products or services sold. It is superfluous to remind them of their duty to the stockholders. They also have responsibilities to their employees, to the purchasers of their goods, to their employees, and to the public as a whole. Their responsibilities to their customers is taken care of by the customers and by the sales departments with more or less wisdom. Responsibilities to the public as a whole, to the community, local or national, is sidestepped except for superficial lip service. Responsibilities to the producers of their goods or services are handled in a distinctly unwise fashion, diametrically opposite that which is adopted toward stockholders. Every effort is made to secure adequate profits for the stockholders, and to pay dividends which will make the shares of the corporation an attractive investment and assure them a ready market at a satisfactory price. When the full profits are not paid out as dividends, the remainder is placed among the assets of the company for the benefit of the stockholders. There is no such tender solicitude for the employees of the corporation. The attitude of the executives is that labor is a commodity to be purchased in the open market like coke, pig iron, and paint. Labor, the employees, are not treated as co-participants in the income of the corporation and given the same consideration as the stockholders. The primary consideration of the executives should be for their employees, and if the executives were possessed of an iota of wisdom, they would so direct their affairs that their employees receive the utmost consideration in both of the capacities they occupy, as consumer and producer. The universal practice, at the present time, is to recognize the employees as producers, but to ignore them as consumers. When employees are recognized only as producers, the corporation executives can so justify their efforts to keep wages at the lowest practical minimum, as a step toward financial efficiency, just as they would seek to avoid wasteful use of material in manufacturing operations. If employees are recognized as consumers as well as producers, the efforts of the executives to impose minimum wages are lacking in wisdom. The criterion of good judgment, in the latter case, is the payment of largest possible amount of wages to the workers. The goods produced by the people of the world are consumed by the people of the world. The money used to purchase the goods produced by the people of the world is earned by the people of the world as payment for services in producing the goods consumed by the people of the world. We have no interplanetary commerce, so the bounds of the Earth set the limits to our trading areas. We can ignore international trade and consider the United States as a completely isolated unit supplied with all the materials needed to supply our needs. We could then say that the goods produced by the people of the United States are consumed by the people of the United States, and the money used to purchase the goods produced by the people of the United States is earned by the people of the United States as payment for services in producing the goods consumed by the people of the United States. If the individual personalities are ignored, and the employees of a corporation are considered as the economic representatives of the consumers of the goods of the corporation, then the necessity for paying maximum wages becomes apparent. Unless the consumer has adequate purchasing power, he is unable to purchase the goods produced. Every dollar paid to an employee becomes a dollar of buying power for buying the products of industry. Industry can fix the size of the markets it desires by increasing payrolls to the desired extent. There is nothing novel in this presentation, but this method of financing markets is not being used in spite of the fact that it is the only method that will work. Every executive wants all other industries to pay the higher wages in order to create the larger market for his own products, but he finds nothing that requires him to participate in the wage-raising process. And what would other executives think of him if he should take the initiative in raising wages under any such idealistic conception? The futility of trying to maintain prosperity without adopting such practical conceptions is clearly and disastrously demonstrated by the conditions that prevailed in industry during the 1920 to 1929 decade with respect to the withholding of wages earned by labor. It will be shown that hundreds of billions of dollars that should have been paid to labor was withheld from them in increasing amounts during these 10 years, with the result that the community was bled white of purchasing power, thus reducing to minimum dimensions the market for the goods produced by industry. In this discussion, we can consider the totality of our corporations as synonymous with industry. The gross income of corporations increased at a very rapid rate during the decade 1920 through 1929, the unit period being studied. The figures as compiled by the Collector of Internal Revenue are: all of this income did not come directly from the sale of products or services, but in the final analysis, it could all be traced to such a source. In a previous chapter, the following data on income from salaries and wages were presented and are given here again for comparison. These figures for gross income of corporations and income from salaries and wages are shown graphically, figure 18. The contrast between the two graphs is startling. The corporation income shows a strong upward trend, while wage and salary income is represented by a horizontal line almost entirely devoid of upward trend. The wages and salaries reported to the Collector of Internal Revenue in the income tax returns do not include all the wages and salaries paid by corporations. The larger fraction of salaries paid by corporations are so small that they fall far below the lowest limit for which the filing of income returns is required. The number of persons receiving these low compensations is far greater than the number receiving the wages and salaries which come within the income reporting limits. The line indicating wages and salaries in figure 18 does not, therefore, represent all wages paid by corporations. In order to make reasonable allowances for the unreported wages, the foregoing figures can be multiplied by a factor of 3 throughout. Even when this has been done, the graph is still a horizontal line showing only an insignificant and hardly discernible upward trend. It is the contrast between this line and that representing gross income of corporations which is significant. The wages and salaries earned by the workers as a group did not increase by any substantial amount during the decade. The average annual earnings during the first half of the decade was $14.3 billion, and during the second half $15.3 billion of dollars. This is an increase of approximately 7%. The gross income of corporations was substantially larger during the second half than during the first half of the decade. The average income during the first half was $109.6 billion, and during the second half $146.8 billion of dollars. This is an increase of 34%. Gross income of corporations increased 5 times as fast as the income of labor. This increased income was not paid out as increased wages. Any increases in the rate of wages paid was more than offset by reduction in number of employees, both relative and absolute. There was an increase in productivity per worker that resulted in increased output, particularly during the latter half of the decade. This caused an increase in the cost of raw materials as more were used. We can allow about between $5 and $10 billion of dollars per year for this item, or about $35 billion for the 5-year period. Costs of raw materials remained unchanged within narrow limits during the decade. We can now do some figuring on the basis of the following data which we have available. The table presents in column C the gross income of corporations less the amount of net income. This income shows an increase of about 50% at the end of the decade over the beginning. The average amount of this income for the first 3 years, 1920 to 1922, was $97 billion. These 3 years included a very prosperous year, a year below normal, and normal year, thus furnishing a fair basis for fixing an average income. The amount by which succeeding years' incomes showed increases over this average is given in column D. These figures are the amounts of increased income taken in by corporations and which was not dispersed. It should have gone largely to labor to which it rightfully belonged, to create increased purchasing power to absorb the increased output of industry. These figures are the amounts which the corporations plowed back into their capital structure. These plowed back amounts reached a total, during the decade, of amounts $227 billion. It will be noted that this figure does not include any of the net income of $85 billion at the corporations, of which $34 billion was declared as dividend, and $50 billion plowed back in very proper and orthodox fashion as described in the previous chapter. In order to be as fair as possible in arriving at the amount which the corporations withheld from labor, and therefore from the purchasing power of our domestic market, a number of deductions will be made from the $227 billion figure. The increases in earnings which labor received during the decade reached the cumulative total of $6.2 billion. We will multiply this by a factor of 3 just to be conservative, giving us a total of $18.6 billion. Previous reference was made to the added cost of raw material, and so forth due to increased productivity during the latter half of the decade, and an allowance of $35 billion was made for this item. Deficits of $23.7 billion were reported by corporations during the decade. The reality of these deficits is open to question in a majority of the cases, and the probability is that the deficits reported by some corporations contributed to the profits of other associated corporations. Nevertheless, an allowance will be made of the full amount. These 3 items total $77.3 billion. Subtracting this amount from the starting figure of $227 billion, we have a balance of $149 billion, $900 million. This is the cumulative amount represented by the black area in Figure 19. The plowing in was not uniformly distributed throughout the decade. Starting with an arbitrary 0 at the beginning of the decade, it grew by leaps and bounds as industry adopted labor-saving machinery to increasing extents that increased production and increased income without increasing labor costs, and only slightly increasing other costs, such as for additional raw material. The benefits of increased income were retained by the corporations, and they were permitted to appear to only a very limited extent in the form of increased dividends. This $149 billion, $900 million plowed in during the decade amounts to $15 billion per year if uniformly distributed during the period. If we assume that 80 million people are dependent upon corporation for income, this amount would have supplied each of these individuals with an additional $200 per year, or $1,000 more per year, per family. The economic circuit was deprived of this $149 billion, and the lack of this money, needed as purchasing power created through wages to absorb the products of industry, diminished the dimensions of our greatest market, the domestic market, until it was no longer able to support its own industries. Industry tried to commit suicide by selfishness. If the money represented by the black area of economic piracy, Figure 19, had been paid out as wages and salaries, there would have been no depression in 1929. This type of piracy has been going on for years, and it would eventually produce an economic crash. The increased magnitude of the piracy during the 20s brought the crash on at an earlier date.